John, thank you very much for joining us today. You were in London meeting with investors. I'm curious about some of the investors you're meeting with. Maybe you can describe the nature of these investors. Are they long-only funds, hedge funds, family offices?
Yeah, great to be in London at WNA for second year in a row. I think this year is the all-time record high for attendance, and the event sold out. So lots of interest in the sector, and we've seen the same level of interest amongst institutional investors and family offices that we're meeting this week in London. But I would say it's been incredibly versatile in terms of the interest. I mean, yesterday I met with a energy transition fund. We met with some infrastructure and mining funds. We meet with family offices, and they're all kind of interested in how uranium is playing a role in broader themes related to electrification, decarbonization, and just kind of an interesting commodity play. And I think that's why it's been so appealing to so many different types of investors the last few years.
And are these existing clients that you're meeting with, or are they new investors to the space?
Yeah, we typically split our time between existing shareholders that are looking for market updates, get our latest thoughts on what's going on in the uranium market. But it's always great to meet new institutions that you're meeting for the first time. And many of them are actually very early in their uranium journey, so to speak, in terms of them trying to understand the uranium market. It is an opaque market. It is a quirky market. So we really do our best to help them understand the market fundamentals and really kind of, cut through a lot of the noise, because there has been a lot of noise in the uranium market this year.
And so when you meet with existing shareholders that know the space relatively well, I'm curious what the feedback is you're hearing from these people. Are they concerned about the performance that we've seen this year, given the positive backdrop within the uranium sector?
Yeah, I think that's a fair point. For investors that have been positioned in the sector for, I would say, anywhere from 1 to 3 years or more, it's been a head scratcher year. A lot of them are kind of scratching their heads saying, what is really going on? We obviously had a huge move last year in the price of uranium, which was very back-end loaded, coincidentally. Starting with WNA last year, it seemed to be the catalyst that took the price of uranium up from $60 to $91 at the end of December. But this year has been a lot of mixed messages, a lot of mixed signals that the market's trying to figure out what's real and what's not. I would say there's a lot of wait and see going on, waiting and seeing what the Kazakhs were going to tell us about their production, waiting to see how the U.S. political winds are shifting and how that may affect energy policy. So I think it's been a year of wait and see. I think the utilities have been, a little bit on the sidelines in terms of procuring uranium to find out what was going to happen with the sanctions against Russia, what was going to happen with the waiver process through the Department of Energy. So we have very bullish long-term fundamentals, but we have a lot of wait and see kind of news items that I think have kept people somewhat on the sidelines.
So let's look at the Sprott Physical Uranium Trust, their SPUT product. And I'm curious you're currently sitting on 65 million pounds. NAV's around $5 billion, give or take, depending on what day of the week it is. And I'm curious how many pounds you have acquired this year.
Yeah, so this year I think we purchased about 2.5 million pounds to our stockpile. We were at a premium to our net asset value at a few points earlier in the year. And we took advantage of that by issuing new units and buying more material. And that's the basic mandate of the fund, to make it larger and more liquid so that institutions can participate. And I could tell you, when I talk to institutions and they look at the fundamentals and of the sector, and they say, this is a really interesting commodity with what they think is a long runway ahead of it. And then they say, okay, how do I get positioned in the sector? And often it's a pretty short conversation, because these institutions are obviously trying to deploy significant amounts of capital. And when they look at the liquidity parameters and the market cap profiles of some of the companies, they quickly determine that there aren't that many things they're able to invest in because of internal, constraints and limitations. So the Sprott Physical Uranium Trust is usually a vehicle that they look at and consider. I think it's one of the reasons why it's mostly institutional investors that have positioned themselves. Obviously, there's some of the leading, larger cap companies that they're all looking at, but it's really hard for these institutions at this point in the cycle to go too far down market cap. And I think it's going to change. It is changing, obviously, as these companies recapitalize and their market values go up.
So you mentioned that this year you've acquired 2.5 million pounds year to date. Last year was 4.5 million pounds. The year prior, 2022, was 18 million pounds.
Correct.
Why is the amount this year so low compared to last year and the previous year?
Yeah, well, I think it goes back to, we had a very sharp price increase at the beginning of the year. And then we've obviously had a correction where we've gone from kind of 106 to 80. I think people are kind of questioning, why did we have such a meaningful correction when the long-term fundamentals are real, when utilities clearly need to rebook their contract PALs, and that when you look at the longer-term fundamentals, there's appears to be a 1.3 billion pound shortfall between expected primary production of uranium and expected global nuclear fuel demands to 2040. So I think people sometimes get concerned about, the long-term fundamentals, and become disconnected from short-term, noise, which I think is, we've had to deal with quite a bit of it this year.
Let's look at uranium within the context of the global economy. And Goldman Sachs recently cut their oil forecast, and they just recently cut their copper forecast quite significantly. They took it from $15,000 a ton down to $10,000 a ton for 2025. The reason why they did this is because of this pullback we're seeing in China, but we're also experiencing a slowdown in the U.S. economy, as witnessed by numerous companies when they reported their Q2 numbers. But what impact do you think this slowdown that we're seeing in the global economy is going to have on the uranium price and also the whole overall thesis?
Yeah, there's definitely been an impact to higher interest rates the last 2 years. We definitely see a correlation between the start of the central bank tightening cycle that really commenced in May of 2022. It really did have an impact on a lot of financial assets, including commodities like uranium. But bigger picture, if you kind of take a step back, uranium is incredibly economically insensitive because you really can't substitute uranium. You can't thrift it. Nuclear power stations basically have to buy it to keep their plants running. And that's one of the, I think, main appeals of uranium as an investment, is because it does behave very differently than economically sensitive commodities like oil and copper, which obviously are a little softer right now because the Chinese economy and the Chinese real estate market are struggling.
So let's talk about inventory levels now. And UxC recently came out with a report, and they stated that utilities have been letting their inventory levels draw down in the last couple of years. And when you look at the various regions throughout the world, in the U.S., they acquired approximately 2 million pounds over the last couple of years. The Europeans acquired a similar amount, but China acquired 85 million pounds. Can you speak to this?
Yeah, everybody pays very close attention to utility inventories because they're the largest buyer of uranium in the world. Financial intermediaries and non-utility buyers are a much smaller part of the market. So we look at this data because it's important to get a sense of where we are in the cycle. Where are we in this contracting cycle? And typically, the patterns historically are you have basically restocking cycles followed by destocking cycles. And I think it's fair to say from 2012 to 2020, we were in a destocking cycle where utilities were basically working down excess amounts of inventory. We feel as though that period is now behind us, and then new restocking cycle is underway. And why it's so important is because that's when the really large amounts of uranium get purchased under these long-term contracts. So everyone is always looking for signals around inventory levels and long-term contracting. It seems to us there's a bit of a disconnect between the uncovered requirements that utilities have going out the last few years and what they've been doing the last few years with their inventory levels. As you mentioned, inventory levels appear, based on this report, that they're kind of flat over the last 2 years, with the exception of China. Now, why has China been so aggressively adding to their stockpiles? Well, they're building between 4 and 6 new reactors each year. And it seems as though every few months they have another news release about another batch of reactors that have been approved for construction. So they are stockpiling material in anticipation of a very large build out. Now, the rest of the world obviously is not building out new reactors to the same degree. And so, but they're just maintaining their current levels. We like to think that these utilities should be accelerating their purchases because they have not been essentially replacing the amount of uranium they've been consuming the last few years. And given all the geopolitical uncertainty and the changes in the uranium market, we think there are heightened risks right now to the overall supply chain. So we hope that the contracting cycle accelerates in the back half of this year and into next year, because quite frankly, it's been very, very quiet for the first 6 months of this year.
So the utilities are letting their inventory levels drop down. What about the producers? What are you hearing about them?
Well, the producers are running also very low levels of inventory. I mean, just a week or so ago, Kazatomprom said that their inventories on hand were down to 4 months equivalent production. That's historically a very low number. And that's because they're selling more uranium, and legacy contracts that they had on the books had certain flex options where customers could increase the amount of uranium they would take under the contract terms. And that's, I think, pushed down inventory levels. So I think everybody needs to start building up inventories again, whether it's producers or utilities, because if you look at the WNA data that was released last year, we need 300 million pounds of uranium in the year 2040 to meet all of the anticipated reactor builds. You contrast that against production this year, which might be 150 million odd pounds. There is a huge gap there that needs to be solved ultimately through new mine builds, which are going to require higher prices than where we are right now.
John, another interesting point that happened this year was a number of U.S. brokers have initiated coverage on the uranium sector. And I'm thinking about Citibank, Morgan Stanley, Bank of America, all of which are bullish on the entire sector. Has this helped create more interest, especially from the U.S.?
Yeah, absolutely. I think it's fair to say that in the bear market, not many uranium analysts survived. Very few people were covering the sector anymore. So there was a huge gap of institutional knowledge. And I think that's one of the opportunities which we took advantage of when we entered the space in 2021, realizing that there wasn't a lot of institutional coverage, which is why, we do so many of these interviews, we do so many road shows, really trying to educate institutional investors. And the reason why the coverage is coming back is because the interest is coming back, and people are connecting the dots around uranium's role and obviously in nuclear energy and its importance in electrification, decarbonization, reliable baseload power, how that's helping power the grid, because the grid is becoming ever more unstable. And renewables, have big connection queues, meaning, there's projects that are waiting years to connect into the grid. So all of the existing nuclear power stations we have are really providing that backbone energy for all the, key industries. And obviously there's a expected growth in electricity coming from reshoring of manufacturing, as well as things like AI data centers, which are very energy intense.
There's a lot of chatter online about whether or not Sprott can sell pounds into the open market or also loan their pounds out. Can you speak to this?
Yeah, it kind of comes and goes in terms of rumors and people speculating whether the pounds that are sitting in the trust would be available to them, whether they're a producer or a trader or a utility. And, we try our best to help out the industry by doing things like location swaps. Those have been very popular, particularly as some of the facilities in the nuclear fuel supply chain have come back online. For example, ConverDyn. We've done a number of those. We've done some origin swaps, but we have not sold a single pound in the market. We have not lent any material to anybody, and that's not part of the mandate of the fund. And it's important to reiterate this message, because sometimes I think utilities come to this conclusion in their head that somehow our pounds will be mobile. And it's not a vehicle designed to do that. It's a perpetual trust. Our incentive at Sprott is to grow the vehicle and make it as liquid as possible for institutional investors. So, I kind of hate sounding like a broken record, but I find that I have to talk about this all the time because it does flare up from time to time. And I think it's important to remind people what the intent of the vehicle is.
So if a utility has a strategy of hope, they should not be hoping.
Yeah, they should not be hoping. I love that quote. Please get in line and buy uranium like we have the last few years. And they have every incentive to. And I think it's important that they work obviously constructively with the industry to ensure there's long-term security of supply. And I can tell you, there was not going to be long-term security of supply. The price today was at 30 or 40 pounds. We would not have the new mine builds. We would not have the restarts that have happened. And the industry would be at risk in terms of being able to achieve its very ambitious expansion plans around the globe.
John, as we wrap up, what message would you like to convey to investors who might be concerned about the recent weakness we've seen in the uranium price?
Yeah, well, obviously last year was a breakout year for uranium. The price went up 89%. And again, a lot of it happened in the last few months of the year. And I remember very vividly talking to investors in July of 2023, and a lot of them were down and out and were kind of washed out. And some of them that I talked to said they threw in the towel and they moved on. And then lo and behold, you have a few little bits of news and catalysts and the sector goes. It feels like we've had, after a big move last year, we've had a pause. As I said, there's been a lot of mixed messages from some of the producers, which I think has created a whole lot of confusion around what is really going on. And everyone's been kind of waiting and seeing looking for more signals in the market before they make the next move. So what we tell people all the time is you shouldn't be investing in the sector. You've got a short-term horizon. That's just not the right way to approach it. You're going to be disappointed. You need to take a 2, 3, or 4 year time frame in mind, because the fundamentals over that period look amazing. And so the noise is there, the market volatility that is macro related or interest rate or geopolitically related is going to flush some people out. And that's unfortunate, because I think the fundamentals are going to win the day in time.
Always good to end on a positive note. John, thank you very much for spending time with us today.
Thanks for having me. Enjoy the conference.